Hey, how's it going, everybody? Good to see you. Good to be back. Ed Ponsi here, your FX educator, here on behalf of FX Street once again. I hope you're having a great day. Welcome back. So good to be here. Hey, what a great little setup we had yesterday. Hope you enjoyed that? Just taking a peek at that, right? Seeing how that worked out. And that was on Euro USD. But we're not going to dwell on that because we have a situation going on in the British pound right now. And I want to get over to that right away because everyone's talking about this today. This has a big move. Let's keep it on the GBP USD. And we'll keep it on now. Now, this has been really just a large bottoming pattern. If you look at it from the EU referendum perspective, the big drop right here, and just a large bottoming pattern, and the breakout. But now that breakout is fading, and this 127.75, this area just under 128, is now your big support level, and we can draw another arrow in right here because another big bounce occurred today. Look at that big hammer. Well, it's not really a hammer yet, right? Because that candle is still open. We can't call it a hammer yet, right? We can't make that judgment. But so far, it looks like a really nice bounce off of that level once again, and we've been talking about that level for a long time, going way back to December of last year. That area acted as resistance, just under 128. And then we saw it acting as support in April and acting as support again in May and once again today. And what happened today is fascinating. A poll came out overnight. And according to that poll, we have this runoff election coming. It's 1 week away. And this is in the UK. And Theresa May, the Prime Minister, called for that election. And a poll came out overnight and said that this election isn't looking that great for Theresa May's party, the Conservatives. And it's said that she was going to lose seats. And you can see, can you see where the poll came out? I think you can see exactly where that poll comes out, right? The British pound drops like a stone. But what we're seeing this morning is it gains it all back. So what happened here exactly? Well, we can see the reaction to the poll is very sharp. This is a 5-minute chart, and you basically see 3 red candles here, maybe 4. And let's just put it this way. The British pound is going to lose 100 pips in less than a half an hour. And it's going to be a very sharp move. And then the British pound is going to regain almost all of that ground. The British pound is going to regain almost all of that ground in over the course of the last couple of hours. One of the things that occurred, now why would it start moving at this hour? It's kind of funny. A large bank, and I believe they were called, I believe it's an Australian bank, called into question this poll. First of all, we should all know by now that polls in general, if we learned one thing last year, it was this: polls are not always correct, right? We learned that last year. We learned that during Brexit, almost every poll was wrong. We learned during the U.S. presidential election that most of the polls were incorrect. Polls are not always wrong, right? Most of the polls were correct during the French presidential election recently. So, it's not as if polls were always wrong, but um, I think Macquarie Bank called this specific poll into question and said, look, this methodology on this poll is questionable, and we feel that there's a high margin of error on this poll. So the result is the pound gains all the ground back, and on a daily chart, that looks like a hammer. When you come all the way down and gain it all the way back, the result is a hammer. But of course, this candle, this daily candle, is still going to be open for another 7 or 8 hours, right? Maybe 9 hours. So it's too early to judge a daily candle. And that's not the intention here, but the intention is to try to explain what happened and why, and also to point out that that's a pretty darn good support area. So regardless of the reason why, we've been pointing at this area for a long time. And if you were awake and aware that the price was down there, it was time to buy. And sure enough, if you bought there were pips to be made. Right, and if that area breaks in a convincing manner, then that changes the whole polarity of the British pound. But that has not happened yet. Now, this trend line is gone. We can say that. This trend line can go. But this horizontal, steep trend lines are easily broken. Horizontal support and resistance is a different story. That can hang in there for a long period of time, whereas a steep trend line can break very easily. That's a general rule of thumb in technical analysis. The steeper the trend line, the more easily it can be broken. Okay, so for now, the pound remains above that red line, which means for me, if I'm a short-term trader, I'm bullish as long as it's above that red line. I'm bearish below the red line. Okay, let's move on. I wanted to talk a little bit about New Zealand because the head of the this has been on a roll. This has been one of the sort of quietly one of the stronger currencies over the past few weeks, and I didn't want that to go unnoticed here. We actually had quite a few comments last night from the Reserve Bank of New Zealand, and they were talking about interest rates, and it really looks like are they going to raise interest rates? No, they're not going to raise interest rates, but they did say that financial risks are receding. They were worried about a housing bubble. Now they're less worried about a housing bubble. And they're just saying that there's less risk in the financial system. So that's good news. Dairy prices are recovering, which is good news. I mean, if you have an economy where your biggest export is dairy, then that's huge, right? People don't realize, but dairy is as important to New Zealand as oil is to Canada, and it's hard for some people to grasp that, but it's true. So anyway, this is very bullish technically, and it has broken a lot of resistance, and this resistance area is long gone. Right here, maybe not long gone, about here. about 70.50 that was broken. So I would think a pullback to that area would be a great place to look to buy. This was obviously a bottoming area down here. We don't need to worry about this any longer. So we can get rid of those lines. I would be looking at Fibonacci here. So we go from low to high. There's your 38.2 retracement. Your 38.2 retracement of the current rally brings you right almost exactly to a round number. Isn't that convenient? Right there is almost exactly 70 cents. 1 New Zealand dollar equal to 70 cents at the 38.2 retracement. How convenient, right? That would be a wonderful place to buy, in my opinion. Of course, it might never get there. When you're in a strong trend, 70 cents would be a wonderful place to get in, but you do have strong support prior to that, right in this general area right here, 70.50 area. Lots of former resistance there, which should act as support. So this is the area that I've got my eye on. Here's what you could do, and this is the way I look at it. I don't have to go all in at 70.50. Right? I could maybe buy 50% of a position here. In other words, I don't have to take the entire position at one price point. I could take 50% long at 70.50 and another 50% long at 70 even. And now I've got one fully loaded position with an average cost of 70.25. This is not averaging down if it's planned in advance. In other words, I'm not doubling down on the position. I'm only buying half of a normal sized position at 70.50 and taking the other half at the 38.2 retracement. Of course, if New Zealand dollar heads higher, then this would no longer be the 38.2 retracement, and it would throw the whole equation out of whack. I'm just giving you a thought here. You don't have to enter all at one price point. Here's the problem. Most people, when they do use multiple entry points, it's not planned in advance. They're planning to enter with one price point. The trade goes poorly. Instead of getting out, which they know they should do, what do? They buy more at a lower price point. They average in to the trade, which now the position size is too large. Now they're taking too much risk. And once the position size becomes too large, it becomes very difficult to approach it in a logical manner and to be objective. We need to be objective as traders. We cannot approach it in terms of how we feel at a given moment or what type of mood we're in. We should be completely objective all the time. And if you're averaging into trades, you've already broken that rule. So you're going to break it again, and you're going to average in again if it goes against you. And this is how people blow up their accounts, right? So that's not what we're talking about here. We're talking about a controlled entry. So what often happens in a case like this? Let's say it pulls back and you only get the first entry, right? You get this entry right here. And you do not get the second entry. It never pulls back. It turns out the first entry was great. You never get the second entry. Now you've got a winning trade with half of the normal position size. It's going to be a smaller than normal winner. That's okay. That's okay. See, you cannot allow that to mess with you. You can't say, well, it's too small, I got to buy more. No, relax. There's going to be more trades later. You don't want to become emotional. You don't want to add to the trade. And remember, right, you only add to the position if it's planned. Now, what if your plan said, buy some here and buy the other half down here? But if it doesn't come down here, what if you buy half here, and if it goes up by 50, buy the other half higher? If that was your plan, then you can do that. But obviously, there would have to be an OCO order involved. You can only buy half twice. You can't buy half 3 times. So if you bought the second half down here, the third half would have to cancel. If you bought, in other words, let's just say you bought the dip here of 1/2, and then you bought, maybe you wanted to add to it as it goes your way, as it goes in your favor. You wanted to buy more. Some people do that. Some people buy more as it goes their way, and more and more and more. And that's perfectly legitimate strategy. If you can make that work for you, there's nothing wrong with it. Right? There's nothing wrong with it if you can make it work for you. Okay. But you keep it only in a controlled fashion. Now, I'll give you an extreme example. Let's take a look at dollar yen. Now, dollar yen, we have a trade going, and we're still shooting for the third target here. We've got the stop move down to the first target. So we hit target 1, we hit target 2 already. We hope to hit target 3, but if the price comes back on me, we're going to hit target 1 again. So this was an outstanding trade no matter how you slice it. Right? It's either going to be a good trade or a great trade. Let me get to your question in just a second there, Carlos. But the reason why I pulled dollar yen up was because when it comes to intervention setups, you never know where the Bank of Japan is going to intervene. Right, so let's say, like, remember this last time they were down here? We got down near 100. And this was the last time the Bank of Japan really talked about intervention. Was down here. So here's something that we could have done. Right? We could have said, we could have done 25% at 100, 25% at 98, 25% at 96, 25% at 94. Now, if all 4 of these execute, what's your average? You're not going to get 100% of the trade unless all 4 of these execute, right? If the first one executes, your average price is 100. If the top 2 execute, you get 50% of the entry and your average price is 99. If the top 3 orders execute, you get 75% of the entry and your average price is 98. And if all 4 execute, you get 100% of the entry and your average price becomes what? 97. All right, so that's something that I might use on an intervention. If the Bank of Japan is making a lot of noise about intervention, I might pull something like this out. Why? Because you never know exactly at what point they're going to intervene. Okay, let's take a look at targets, potential targets for New Zealand. Let's get back to that. I just wanted to expand on multiple targets, and then we'll complete our New Zealand setup. So in this case, if both entries executed, your average entry would be 70.25. If not, and that means your stop would have to be under 70, correct? Because you can't have the stop above one of your entries. What about targets? Let's pull this out, pull that Fibonacci out for a second. One of the things I like about this chart, you see this steep drop here? The steep drop, it's almost like a wormhole because the price fell so sharply here. There's really nothing to prevent it from rising, in my opinion. I could see it going straight up to almost 72. And Carlos is saying 71.80. I'm looking at 71.90. Carlos is looking at 71.80. I think we're both in the same ballpark here. We both want to get out of at least part of this trade before we get to 72. And that makes perfect sense to me. So let's say I think that the real resistance is around 71.90, and I want to get out below that. So let's go, like, say 70. If I went 71.75, something like that, I think we're already talking about a 3-to-1 target. We're close to it. But I believe I'm going to have a higher target than this. This will allow me to get out before I encounter some turbulence up ahead in this messy area up here. I'm going to get out of at least some of the trade here. There's more up higher, like up here. There's going to be a target up here as well. Probably just under 73 area. Carlos is looking at 72.60. I had not looked at the weekly, but on the daily I'm looking at a little bit under 73. Let's peek at the weekly. See, the way I see this, like, getting out of a little bit here means I don't have to worry about all this. And then we get another sort of a steep cliff here. I could probably push my luck up into this area here if I wanted to, but I want to get out maybe below 73 just because I'm not trying to push my luck. If I wanted to push my luck, I could try for 73.50. But I'm not going to push it. I'm going to go under 73. There might be some data hitting right now, so just bear with me a sec. Carlos is saying 72.60. You know, I might switch this, but let me go back. I'm just saying 72.80 for the moment, but I'm going to reserve the right to change that up. I want to go back to the daily. Steep cliff, first gate to the wormhole. Exactly, right? I love that. I love the idea of those steep drops. I love that because there's no time to create support and resistance levels. This could go. I could put this higher. I could put this up here, closer to 73, like maybe 72.90. I just don't really feel the need to push it. But I could. I'm still kicking around on this one. Exactly where I want to put this second target. But I could go up to 72.90, and I've got 71.75. My stop is definitely under 70. This is just all kind of loosey-goosey right now. I'm going to refine this during the break. But somewhere down, I'm going to have a stop somewhere down here, like 69.75 area, something like that. Let me just see if the math works. I'm just sort of loosely tossing this together for the moment, just seeing if it works. And my entry, I'm looking for right around here. If I do one entry, it'll be around 70. It's about a 75 pip stop if I enter here. And then this target up here would be close to 240. It's about 3 to 1. Let me just check and see if GDP Canada just hit. It's a little on the weak side. Oh, month over month it was strong, but Q over Q it was on the weak side. Gotcha. Because they must have okay. I'm having a little trouble processing that. Let me just see how the Canadian dollar is reacting. Oil's been really weak here. Give me a 5-minute. Let's see if we can take a peek here. Now here's the thing. If I use that dual entry, that lowers my entry. Ooh, look at that. Canadian dollar got much stronger there on the GDP figure. And then rebound. Okay. Back to the New Zealand dollar setup. Now keep this in mind. If we do the dual entry, 50% here and 50% here, that lowers my entry to 70.25. That means we would calculate everything as, so if my cost basis is 70.25, that means my stop is 50 pips. And this target would be, that 71.75 target is 150. That's 3 to 1. This is better than 5 to 1 up here. We could even go wider with the stop. So using if I use the multiple entry system, I could go wider with the stop, which means I have a better chance of not being stopped out. What worries me about the first target when looking at the steep cliff is the extended range candle is about 80 pips closing within 85% of the range. Well, you know, I think I'm going to throw a third target in here just so I can, I think I'm going to put a third target in here, like just an easy third target. Let's see. Like just a 1-to-1 on, see, this is interesting. If we get both entries, this becomes 3 to 1. If we don't get both entries, this is the 3 to 1. but it's 3 to 1 either way. But I believe I'm going to use this as a first target. That's 7,100. Just to make it easy. Just so I can bring the stop up to break even, no matter which. See, I don't know going into this trade whether I'm going to get both entries. I don't know if I'm going to get both entries. I might just get one. Right? And that's the thing. You don't know that going into the trade. So for now, I'm going to say 7,100 for the first target, which if I get both entries, that would be exactly 1 to 1. If I don't, it's less than 1 to 1, but that's okay because this is going to be 3 to 1 up here, and I'm only trading with half a position size. All right, this is an interesting setup. All right, let's play it out. Let's see what happens here. So I've got entry at 70.50 and at 70, half and half. Doing multiple entries, multiple targets, and one stop on the Kiwi. So let's put another green line at 70. 2 green lines, 2 entries. Okay, gang, let's see what happens. All right. Okay, we've run a little late, so but don't worry, I'll be back in less than a half hour, and we'll start up again with part 2. This is Ed Ponsi signing off. I'll speak to you again very soon.